ERM Power is an energy retailer to the commercial and industrial segment in Australia. Now, commercial industrial is about half of all energy consumed, and we have about 23% market share of that market in Australia. We also provide energy efficiency solutions to our customers to help them improve their energy productivity. There's a few things. I mean, the first thing is our customer satisfaction. We have a customer satisfaction of 92. That means 92% of our customers are either satisfied or very satisfied with our service. We achieve that because we bill accurately, we bill in a timely way, we have outstanding account management, we have we flexible in the way we do business, and we provide advice and guidance on energy efficiency. That absolutely differentiates us from our competitors who have a very low customer satisfaction. What that means is that we have industry-leading customer recontracting rates, which is why we have been able to grow our market share. The second thing that really differentiates us is that we care not just about the supply of energy to the customer, we also care about how they manage their demand. All of our competitors have made long-term bets in wholesale baseload energy and aren't motivated like we are to put ourselves in the shoes of our customers and help them manage both their supply and demand. I guess the first thing to think about in the wholesale electricity market, as we see more and more renewables entering into the grid and driving to a lower emissions sort of energy source, there are real technology challenges, real challenges to provide secure, available, reliable, and cost-effective energy. The combination of our trading capability and our gas peaking capability really helps us better manage that for our customers. Customers, given energy is such a volatile commodity and has increased in cost, almost doubled over the last couple of years, customers are thinking more and more about how do I manage that volatile commodity in my supply chain. So we start with giving them insights into their consumption so they can put projects in place to help them better improve their energy productivity. That might include things like on-site generation, power factor correction, demand response, energy efficient lighting, and a whole combination which will help them either use less electricity or use it in a way which delivers better value for their business. Our performers brought us a capability that we didn't previously have. Outperformers has a lot of experience in providing advice and projects to complex manufacturers to help them improve their energy efficiency. They're also able to they're certified to deliver energy efficiency certificates for their customers, which again is a capability that we didn't have before. So it helps round out our portfolio of services in the energy solutions market. But sure, this is a market that's really unfolding as we speak, and absolutely we see the opportunity for incremental investments in companies that have specific niche technologies or serve specific customer segments to help improve energy productivity. But the way we think about capital management is we sort of every half, as we report our results, we think about the liquidity, the money we require to operate the business. We think about our base dividend, which is about 3.5 cents fully franked per half, or 7 cents fully franked per full year. We say, okay, well, that's how much money we're going to need to operate the business. Then what sort of investments are we likely to need to make over the next short while? So if you like, it's a war chest for inorganic and organic investments that we want to make, and we talk to the market about that. And then if there's any cash left over after thinking about our liquidity and our div and the war chest that we want to keep, we'll look at the most efficient way we can return that to shareholders. At our last result, we increased the dividend slightly for that half to 4 cents fully franked, and we initiated a buyback of about $20 million because we thought that that was something that would bring value to our shareholders. Yeah, we sold our business in the US, and that will help with some cash inflow as well as some decreased liquidity, if you like, needs. So, you would imagine that we're going to have a little bit more cash to distribute. We bought Outperformers, so that was about $16 million. That'll be now out of the equation. So when we get to our February interim, results announcement, we'll talk to the market again in terms of the liquidity, the dividend, what we will be keeping aside for organic and inorganic growth, and then if there's anything left over, then we'll talk about ways we can return that efficiently to our shareholders.